Imagine paying $100 million for a shopping mall, only to watch it lose millions of dollars every year. It sounds impossible until you realize some of America's largest malls have sold for less than the value of the land beneath them. At the same time, other malls just a few miles away are packed with shoppers, have waiting lists for tenants, and generate tens of millions in annual income. Most people assume malls died because of Amazon, but that's one of the biggest myths in commercial real estate. The truth is that malls rarely fail because people stop shopping. They fail because the economics behind them quietly collapse long before the parking lot looks empty. Owning a shopping mall isn't about collecting rent from clothing stores. It's about managing one of the most complex businesses in real estate, where a handful of decisions can turn a billion-dollar asset into a financial disaster. When most people picture a mall owner, they imagine someone sitting back while dozens of stores mail rent checks every month. It feels like the ultimate passive investment. After all, hundreds of businesses operate under one roof. Thousands of customers visit every week, and every purchase seems like money flowing into the owner's pocket. But that picture couldn't be further from reality. A shopping mall is less like owning an apartment building and more like running a small city. Every empty storefront reduces foot traffic. Every struggling tenant threatens another tenant's sales. Every maintenance delay becomes visible to thousands of visitors. The owner's job never ends because the value of the entire property depends on keeping hundreds of moving pieces working together. That's where most first-time investors completely misread the business. The biggest surprise is that a mall doesn't actually sell products. It sells access. Retailers aren't paying for walls and a roof. They're paying for customer traffic. Every lease is essentially a bet that enough people will walk past a store's front door to justify paying rent. That's why the strongest malls carefully mix restaurants, luxury brands, entertainment venues, fitness centers, grocery stores, movie theaters, and everyday retailers. One successful tenant attracts customers who accidentally spend money at several others. This network effect creates something commercial real estate professionals call an ecosystem, where every store either strengthens or weakens the businesses around it. Once that balance breaks, the economics begin changing much faster than most people expect. This is why anchor tenants became so important. Department stores like Macy's, Nordstrom, or Dillard's weren't always the biggest profit generators for the property owner. In many cases, they negotiated surprisingly favorable lease terms because they brought something much more valuable than rent: consistent customer traffic. Thousands of shoppers visiting an anchor store would naturally pass dozens of smaller retailers along the way. Those smaller tenants could then justify paying much higher rent because their sales depended on that daily stream of customers. Lose one major anchor, and suddenly the stores surrounding it begin selling less. Then another tenant leaves. Then another. Before long, vacancy spreads through the building like falling dominoes. The empty stores aren't the cause of failure. They're usually the symptom. That chain reaction explains why malls can look perfectly healthy on the surface while quietly heading toward financial trouble. Commercial leases often last 5, 10, or even 20 years. A struggling retailer might stay open simply because it's locked into a lease. Customers still see lights on and stores operating, but behind the scenes, many tenants are losing money and waiting for their contracts to expire. Once those leases begin ending, vacancies accelerate, lenders become nervous, and refinancing becomes much harder. By the time the public starts saying a mall is dying, the financial damage usually began years earlier. Money flows through a mall in more ways than most people realize. The largest source is usually base rent, where each tenant pays a fixed monthly amount for its space. But that's only the beginning. Many leases also include percentage rent, meaning the mall owner earns an additional share if a retailer's sales exceed certain targets. Then come common area maintenance charges, often called CM fees, where tenants help cover cleaning, landscaping, parking lot repairs, lighting, security, snow removal in colder states, and dozens of other shared operating expenses. Property taxes, insurance costs, and advertising programs may also be partially recovered from tenants, depending on how each lease is structured. That's why two malls with similar rent levels can produce completely different profits. The quality of the lease agreements matters almost as much as the tenants themselves. This is also why experienced investors spend months studying lease documents before buying a mall. They're not just buying buildings, they're buying contracts. One property may have tenants locked into strong long-term agreements with annual rent increases built in. Another might have dozens of leases expiring within the next 2 years, creating enormous uncertainty. On paper, both malls may report similar income today. 5 years later, one could be thriving while the other struggles with half its storefronts sitting empty. The paperwork often tells a more important story than the building itself. Buying a shopping mall is nothing like buying a small retail strip center. Even neighborhood malls can cost anywhere from several $1 million to well over $50 million depending on location, occupancy, and condition. Regional malls in major metropolitan areas frequently trade for hundreds of millions of dollars, although distressed properties sometimes sell at dramatic discounts when lenders want out. But the purchase price is only the first check in owner rights. Large due diligence costs, environmental inspections, engineering reports, legal reviews, financing fees, title insurance, and closing expenses can easily reach hundreds of thousands or even millions of dollars before ownership officially changes hands. That's before spending a single dollar improving the property. Building a new. At the lower end are community malls and aging retail centers that frequently compete on convenience instead of prestige. Many were built decades ago, when department stores dominated American shopping habits. As consumer behavior changed, these properties faced increasing pressure from online shopping, lifestyle centers, and mixed-use developments. Some adapted by replacing traditional retail with gyms, medical clinics, colleges, grocery stores, apartments, hotels, or entertainment venues. Others never evolved and slowly lost relevance. That difference reveals one of the most important lessons in this entire business. Successful mall owners don't simply rent space. They constantly reinvent the destination before customers give them a reason not to return. People who own shopping malls are rarely individuals writing a personal check. In today's market, most successful malls are controlled by large real estate companies, pension funds, insurance firms, private equity groups, family offices, or real estate investment trusts, better known as REITs. There's a simple reason for that. A shopping mall isn't just expensive to buy, it demands constant capital. Roofs eventually need replacing. Parking lots crack. HVAC systems wear out. Tenants request renovations. A single unexpected repair can cost millions of dollars. Large ownership groups can spread that risk across dozens of properties, while an individual investor may have all of their wealth tied to one asset. That difference becomes critical when the economy slows down. But here's what almost nobody tells you. Even the largest mall owners don't always own every part of the property. It's common for department stores, restaurants, hotels, office towers, apartments, or even parking garages to have different owners sharing the same development. Each owner has different financial goals, lease structures, and investment timelines. Managing those relationships can become as important as attracting shoppers. A disagreement over redevelopment or maintenance can delay projects for years, costing everyone money without customers ever realizing what's happening behind the scenes. The expenses begin long before the first dollar of profit arrives. Most people focus on the purchase price, but experienced investors obsess over operating costs. A shopping mall is one of the most expensive commercial properties to maintain because almost every square foot is shared by the public. Escalators require inspections. Elevators need servicing. Thousands of parking spaces must remain safe. Security teams patrol day and night. Cleaning crews work before stores open and after they close. Landscaping, lighting, plumbing, roofing, pest control, snow removal in colder states, and routine repairs continue whether the mall is busy or completely empty. The larger the property, the faster these costs multiply. Insurance is another silent expense that catches new investors off guard. A shopping mall welcomes millions of visitors each year, creating countless opportunities for accidents. A customer slipping on a wet floor, storm damage to the roof, vandalism, or even a major fire can trigger enormous claims. Comprehensive insurance is essential, but premiums have climbed significantly in recent years as construction costs and weather-related losses have increased. Add rising property taxes, utility bills, cybersecurity for payment systems, and legal compliance with accessibility and safety regulations, and the fixed costs become staggering before considering debt payments. Then come the costs hidden inside tenant relationships. Every time a retailer leaves, the space rarely becomes profitable overnight. The owner may have to demolish interior walls, update electrical systems, replace flooring, repaint, install new storefronts, or divide one large unit into several smaller ones. During that time, no rent is coming in, yet construction bills continue arriving. Some landlords even provide tenant improvement allowances, essentially helping pay for a retailer's build-out in exchange for signing a long-term lease. It sounds expensive because it is, but refusing to invest often leaves storefronts vacant even longer. This is where the economics become fascinating. A shopping mall doesn't succeed because every tenant pays the highest rent. It succeeds because every tenant plays the right role. Luxury brands create prestige. Popular restaurants increase evening traffic. Movie theaters keep visitors on the property longer. Fitness centers generate early morning visits. Grocery stores create weekly habits. Children's entertainment attracts families who then shop elsewhere. The strongest malls carefully engineer customer movement, almost like designing traffic inside an airport. Every lease decision affects dozens of neighboring businesses in ways that spreadsheets alone can't predict. That design leads directly to how mall owners actually make money. The most obvious source is rental income, but sophisticated owners know rent is only the foundation. Long-term leases create predictable cash flow that lenders value, allowing owners to refinance properties and access additional capital for expansion or redevelopment. Stable occupancy often becomes just as valuable as the rent itself because it increases the property's overall market value. In commercial real estate, growing the value of the asset can sometimes generate larger returns than the yearly income. There's another layer many shoppers never notice. Some leases require tenants to share a percentage of sales after reaching certain revenue thresholds. Imagine a retailer paying fixed rent plus a percentage of every dollar earned above an agreed target. During holiday shopping seasons or major product launches, that additional income can significantly boost the mall owner's returns without adding another tenant. That's why successful landlords care deeply about store performance. When retailers sell more, everyone wins. Advertising creates another surprisingly profitable revenue stream. Digital billboards, kiosks, promotional displays, seasonal events, product launches, and branded experiences all generate income while making the property feel more active. During the holidays, temporary kiosks selling gifts or specialty products often pay premium short-term rents because foot traffic reaches its highest levels. Empty space that earns nothing for most of the year can suddenly become one of the highest return areas inside the mall during peak shopping seasons. Parking, once considered an afterthought, has also become a business of its own in many urban markets. Premium parking spaces, valet services, electric vehicle charging stations, and event parking all create additional income. Some mixed-use developments generate revenue from office workers during weekdays and entertainment visitors at night, allowing the same parking infrastructure to produce income around the clock. The parking lot isn't just supporting the mall anymore, it's becoming another profit center. But here's where most first-time investors completely misunderstand customer behavior. People rarely visit successful malls because they need to buy something. They visit because the mall solves several problems at once. It provides convenience, climate-controlled comfort, entertainment, dining, social interaction, and variety in a single trip. Parents can shop while children play. Friends can meet for lunch before seeing a movie. Someone might arrive intending to buy one item and leave with 5 purchases simply because everything is within walking distance. The longer people stay, the more opportunities retailers have to make sales. Time, not square footage, becomes the owner's most valuable asset. That's exactly why online shopping hasn't destroyed every mall. E-commerce is incredibly efficient at delivering products, but it struggles to replace experiences. A luxury boutique, an upscale restaurant, a comedy club, a fitness center, or a family entertainment venue offers something a delivery truck never can. The malls thriving today have shifted away from being collections of stores and toward becoming destinations. Retail has become only one piece of a much larger experience economy. Of course, creating those experiences isn't cheap. Payroll remains one of the largest ongoing expenses, especially for management teams, maintenance crews, cleaning staff, security officers, marketing departments, and leasing professionals. Utilities can reach astonishing levels because heating, cooling, and lighting hundreds of thousands, or even millions, of square feet requires enormous amounts of energy. Property taxes often increase as surrounding neighborhoods develop, while interest payments on commercial loans can swing dramatically when rates rise. Many owners discover that a profitable mall on paper becomes far less profitable after accounting for debt service. Marketing is another expense that beginners frequently underestimate. A successful mall doesn't simply unlock its doors and hope shoppers appear. It hosts seasonal festivals, holiday events, concerts, community gatherings, fashion shows, charity fundraisers, and promotional campaigns designed to keep visitors returning throughout the year. Every event costs money, but every event also strengthens customer habits. In the mall business, attention is an asset and maintaining it requires constant investment. This leads to one of the industry's most dangerous financial traps: High occupancy doesn't always mean high profitability. A mall can appear fully leased while several tenants negotiate rent reductions, receive temporary concessions, or struggle to stay in business. Owners sometimes accept lower rents because a partially occupied mall is still more attractive than one filled with empty storefronts. Investors who focus only on occupancy rates without understanding lease quality often pay far more than a property is actually worth. Debt creates another hidden danger. Shopping malls are usually financed with large commercial loans, meaning rising interest rates can dramatically increase borrowing costs when loans mature. A property generating healthy cash flow during periods of low interest rates may suddenly face much higher financing expenses during refinancing. If property values also decline, lenders may require owners to contribute additional equity just to keep the loan in place. That's why many mall failures begin in the financing office rather than on the sales floor. The final trap is believing that yesterday's success guarantees tomorrow's performance. Consumer habits evolve constantly. A neighborhood that supported a thriving mall 20 years ago may now prefer mixed-use developments, outdoor lifestyle centers, or online shopping for everyday purchases. Owners who fail to reinvest gradually lose their competitive advantage one renovation at a time. The buildings themselves rarely become obsolete overnight. The business model does. And recognizing that shift before everyone else is often the difference between owning one of America's most valuable commercial properties and owning one of its most expensive mistakes. The biggest mistake new investors make is believing a shopping mall is simply a larger version of a strip center. It isn't. A strip center is mostly about collecting rent from independent businesses. A mall is an operating ecosystem. Every decision affects something else. Move a popular coffee shop from one entrance to another, and customer traffic changes. Add a luxury retailer, and nearby stores may see higher sales. Replace a department store with a family entertainment center, and suddenly people stay for 4 hours instead of 1. Successful mall owners don't just lease space. They design human behavior. That's why the most valuable malls are planned almost like miniature cities rather than real estate projects. Walk through a top-performing mall and almost nothing is there by accident. Restaurants are often grouped together to create a dining destination. Luxury brands are placed where their image isn't diluted by discount retailers. Escalators intentionally encourage shoppers to pass storefronts instead of taking the shortest route. Even seating areas are positioned to keep people inside longer. The goal isn't simply to help visitors find what they're looking for. The goal is to create opportunities for unexpected purchases. Every additional minute someone spends inside the property increases the chance they'll spend more money. This is also why successful malls constantly measure data most shoppers never think about. They track foot traffic, dwell time, parking patterns, sales per square foot, lease renewals, customer demographics, and even which entrances visitors use most often. If one wing of the mall begins receiving less traffic, management reacts before retailers start leaving. In this business, small changes in customer movement can become multi-million-dollar financial problems if ignored long enough. So, how does someone with no experience realistically get into this industry? The answer is almost never by buying a shopping mall first. The smartest path is to understand commercial real estate before risking millions of dollars. That starts by learning how commercial leases work, how properties are valued, and how financing decisions affect investment returns. Free educational resources from the CCM Institute, NAIOP, the Urban Land Institute, and the International Council of Shopping Centers offer an excellent foundation. Reading market reports from CBRE, JLL, Cushman & Wakefield, and Colliers also teaches how professionals evaluate retail properties. Before spending money, spend time learning the language of the business. The next step is gaining experience where someone else pays for your education. Many successful mall owners didn't start as investors. They started as property managers, leasing agents, commercial brokers, asset managers, retail analysts, or development associates. Those roles teach how leases are negotiated, how tenants are selected, why vacancies occur, and how properties are managed during both strong and weak economies. A few years inside the industry often provides insights worth far more than any classroom or online course. Relationships become the next competitive advantage. Shopping malls operate through networks of lenders, brokers, contractors, attorneys, architects, leasing professionals, and retailers. Most major opportunities never appear on public listing websites because they're discussed privately long before reaching the market. Attending ICSC conferences, local commercial real estate events, and networking through organizations like NAIOP or ULI allows newcomers to meet the people who actually make deals happen. In commercial real estate, opportunities often follow relationships rather than advertisements. That's where the first practical actions should begin. Instead of searching for malls to buy, spend a week analyzing the ones already around you. Visit during weekdays and weekends. Count occupied storefronts. Notice which entrances attract the most visitors. Observe which restaurants have waiting lines and which stores remain empty. Compare those observations with publicly available demographic data and local population growth. Then study recent commercial real estate transactions through brokerage reports and county property records. Developing the ability to recognize a healthy mall from a struggling one is one of the highest value skills an investor can build. Many beginners assume they have only two choices: buy a mall or don't. In reality, there are several ways to enter the business. Some investors purchase small neighborhood shopping centers before moving into larger regional malls. Others invest alongside experienced sponsors through commercial real estate partnerships. Some specialize in redeveloping underperforming retail properties into mixed-use destinations with apartments, offices, medical clinics, or entertainment venues. Others manage malls on behalf of institutional owners before eventually acquiring properties themselves. The smartest investors usually increase complexity gradually instead of betting everything on their first acquisition. Buying an existing mall is generally less risky than building one from scratch because the infrastructure, tenants, and customer base already exist. But that doesn't automatically make it a good investment. A fully occupied mall with weak tenants can be far riskier than a partially vacant property in a growing market. Sometimes distressed malls become attractive opportunities because the underlying location remains valuable even if the current business model has failed. Experienced investors often see redevelopment potential where others see abandonment. Converting obsolete retail space into apartments, healthcare facilities, educational campuses, hotels, or logistics centers has become one of the industry's fastest-growing strategies. Building a brand new enclosed shopping mall, however, has become increasingly rare in the United States. The financial risk is enormous, development timelines can stretch for years, and consumer preferences continue evolving. Developers today are far more likely to build open-air lifestyle centers or mixed-use projects that combine retail with housing, offices, hotels, and entertainment. Diversifying revenue sources makes these projects more resilient when retail spending slows. Franchising, unlike many other businesses, doesn't really exist in the traditional mall ownership model. While individual restaurants or retail brands inside the mall may be franchises, the mall itself is typically independently owned or controlled by investment companies. That means success depends less on following a franchise system and more on understanding real estate finance, leasing, redevelopment, and long-term asset management. Many people wonder whether buying a shopping mall with little or no money is possible. Realistically, purchasing a quality mall with zero capital is extremely unlikely. Lenders expect significant equity because of the size and complexity of these transactions. However, creative financing does exist. Seller financing occasionally appears when owners struggle to sell large properties. Joint ventures allow investors to contribute expertise while financial partners provide capital. Commercial mortgage-backed financing, institutional loans, and for smaller retail centers, traditional bank financing may also be available depending on the property's performance. SBA loans generally aren't designed for acquiring large shopping malls, so investors usually rely on commercial real estate lenders instead. For someone without substantial capital, the closest realistic alternative is becoming valuable before becoming wealthy. Learn underwriting. Master lease analysis. Understand redevelopment. Build relationships with investors who need those skills. Capital often flows toward people who consistently identify good opportunities and know how to manage them. In commercial real estate, expertise frequently opens doors that money alone cannot. But here's the challenge that could change everything. The future of shopping malls isn't being decided by retailers. It's being shaped by technology, interest rates, and changing consumer expectations. Online shopping continues taking routine purchases away from physical stores, forcing malls to offer experiences instead of convenience alone. At the same time, higher interest rates make borrowing more expensive while reducing property values. A mall that looked profitable during periods of cheap financing may suddenly struggle under higher debt costs. Owners who fail to adapt quickly can find themselves trapped between declining retail demand and rising financial obligations. Few stories illustrate this better than the rise and fall of many malls owned by CBL and Associates Properties. During the 1990s and early 2000s, the company expanded aggressively, owning dozens of regional malls across the United States. For years, the strategy worked because department stores remained strong traffic drivers. But consumer behavior gradually shifted online. Several major anchor retailers filed for bankruptcy, vacancies increased, and debt became harder to manage. By 2020, CBL entered bankruptcy protection, forcing a massive financial restructuring. The lesson wasn't simply that e-commerce defeated malls. It was that heavy debt combined with changing customer habits can overwhelm even experienced operators if adaptation comes too late. Meanwhile, companies like Simon Property Group demonstrated a different approach. Rather than relying solely on traditional retail, they invested heavily in premium destinations, entertainment, dining, outlet centers, digital technology, and redevelopment projects. They also acquired struggling competitors and repositioned properties instead of abandoning them. The lesson isn't that every mall can become successful. It's that owners who continuously evolve often outperform those who simply collect rent and hope conditions improve. Today's mall looks very different from the one built 40 years ago. Decades ago, department stores were the main attraction, with smaller retailers surrounding them. Now entertainment, food, healthcare, fitness, residential housing, hotels, co-working spaces, and even universities are becoming major traffic generators. The definition of a shopping mall is quietly changing from a place where people buy products into a place where people spend time. That evolution is creating opportunities for investors willing to rethink what retail real estate can become. The malls most likely to survive aren't necessarily the biggest or the newest. They're the ones with multiple sources of income, strong financial discipline, flexible redevelopment plans, and management teams willing to adapt before they're forced to. They understand that customer behavior will continue changing, and they build businesses capable of changing with it. That's the real economics of owning a shopping mall. It has never been about owning a building. It's about owning a destination that people keep choosing, even when they have countless alternatives. If everything goes right, owning a shopping mall can become one of the most powerful wealth-building investments in commercial real estate. A well-located mall with high occupancy, financially healthy tenants, and disciplined management can generate millions of dollars in annual net operating income. As rents gradually increase and vacancies remain low, the property's value often rises as well. That's because commercial real estate is largely valued by the income it produces. Increase the income, and the market value usually follows. A successful owner isn't just collecting rent every month. They're building an asset that can appreciate over decades while producing consistent cash flow. That creates opportunities most people never consider. Owners can refinance the property after increasing its value, using the additional equity to acquire another shopping center or fund a redevelopment project without selling the original asset. Some expand into multiple markets, building portfolios that reduce dependence on any single location. Others transform underused land into hotels, apartments, offices, self-storage facilities, or medical buildings, creating entirely new revenue streams from property they already own. The land itself often becomes just as valuable as the mall sitting on top of it. But those success stories hide an uncomfortable reality. A shopping mall can also become one of the fastest ways to lose enormous amounts of money if the economics turn against you. High debt combined with falling occupancy creates a dangerous cycle. Empty stores reduce customer traffic. Lower traffic hurts the remaining retailers. More retailers leave, causing lenders to worry about the property's future. Refinancing becomes more difficult just as expensive repairs become unavoidable. Before long, the owner is spending more money protecting the investment than the investment is generating. Unlike many businesses, you can't simply shrink a shopping mall during difficult times. The roof still covers the same number of square feet. The parking lot still requires maintenance. Property taxes still arrive. Insurance premiums still have to be paid. Security can't disappear because fewer shoppers visit. Many operating expenses remain almost identical whether the mall is 95% occupied or 60% occupied. That's why declining revenue can quickly become a cash flow crisis. Economic downturns make the situation even more challenging. During recessions, consumers reduce discretionary spending, retailers close underperforming stores, and new tenants become harder to find. At exactly the moment rental income begins falling, financing often becomes more expensive as lenders tighten their standards. Owners with strong balance sheets usually survive these periods. Those carrying excessive debt often don't. Poor management creates another path toward failure. Delaying maintenance saves money in the short term but slowly damages the customer experience. Ignoring tenant complaints increases turnover. Failing to modernize the property allows competitors to attract shoppers instead. Every year an owner postpones necessary improvements. The cost of catching up usually becomes even greater. Shopping malls rarely collapse because of one catastrophic decision. They decline through hundreds of small decisions that slowly weaken the property's competitive position. That's why the strongest operators think differently from struggling ones. They don't measure success by how many stores they lease today. They focus on whether customers will still choose their property 5 or 10 years from now. They constantly test new entertainment concepts, upgrade dining options, improve technology, analyze visitor data, and redevelop outdated spaces before they become liabilities. They understand that protecting long-term relevance matters more than maximizing short-term rent. Perhaps the most important lesson is that diversification isn't optional anymore. The malls surviving today generate income from far more than traditional retail. Apartments create residents who shop downstairs. Offices bring weekday traffic. Hotels introduce tourists. Medical clinics generate daily visitors. Entertainment venues fill evenings and weekends. Fitness centers create morning activity. Every additional use reduces dependence on any single industry. Modern shopping malls increasingly resemble mixed-use communities rather than collections of retail stores. Financial discipline separates the winners just as much as innovation does. Successful owners resist overpaying during booming markets, maintain cash reserves for unexpected downturns, and avoid taking on debt they can't comfortably service during weaker years. They recognize that commercial real estate moves in cycles, and surviving the difficult years often matters more than maximizing profits during the good ones. The irony is that the most valuable shopping mall owners often spend surprisingly little time thinking about shopping. They think about demographics, transportation, housing development, population growth, consumer psychology, entertainment, urban planning, and local economics. They understand that retail follows people, not the other way around. If the surrounding community thrives, the mall has a chance to thrive with it. If the community declines, even the best managed property faces an uphill battle. So the real economics of owning a shopping mall have very little to do with collecting rent checks, CKs, and everything to do with creating a destination people repeatedly choose over every available alternative. The building itself is only the platform. The real product is convenience, experience, community, and time. Get those right, and tenants compete for space. Get them wrong, and even the most beautiful building eventually becomes an empty shell. The final lesson is simple. The shopping mall isn't the business. The ecosystem is. The stores, the restaurants, the entertainment, the leases, the financing, the customer experience, and the surrounding community all depend on one another. Ignore even one piece for too long, and the entire system begins to weaken. Master that system, however, and a shopping mall can remain one of the most valuable long-term assets in commercial real estate. So that's the reality of the shopping mall business. It's not a get-rich-quick investment, and it's certainly not passive income. But for investors who understand the economics, manage risk with discipline, and continuously adapt to changing consumer behavior, the long-term opportunity can still be extraordinary. If you enjoy deep business breakdowns, real-world investment research, and the hidden economics behind major industries, join our community through the link in